your credit score may drop 20 points this summer, even if you've been making your payments on time. Fico is releasing a new credit model that is rolling out this summer. If you've been carrying credit card debt month to month, lenders will start factoring that into your score like never before. Now, this can have a major impact if you're trying to get new credit cards, mortgages, loans, because all this is going to affect what you can qualify for. But I don't want you guys to worry about it. I'm going to walk you through exactly what's happening and how to protect yourself. Now, just to give you guys a quick introduction of FICO. Now, it was widely introduced for consumer use in 1989. Now, about 90% of lending institutions use this model in order to qualify you for things that you need in life. So just make sure that you guys watch the whole video because it just will have a big impact for you. Now, let's talk about the major changes that are happening with FICO. With the new version, what they're going to do is they're going to look at consumer balance history over the last 24 months, meaning that if you're carrying a balance for a long time, it could hurt your credit score more than ever. Now, they've also been looking at trending data, especially in the lending side. Now, this primarily is going to look how you've made your payments every month, not just carrying a balance, meaning that are you making the minimum payment or are you making extra payments? So the folks that, one, don't have large balances, are keeping their utilization low, are going to have better scores. And then people that are also being able to make higher than minimum payments, it will also not be another positive piece for them. Now, in previous FICO models, your score was based more on recent credit activity. Now they're looking at a longer picture. Now let's talk about some of the differences of the new proposed FICO system versus some of the previous ones. Now, like I mentioned, more emphasis is going to be on past balances, carrying credit card debt month to month. That's going to have a big impact. And then you're going to have higher penalties now for having late payments. So if you have a derogatory or recent derogatory, this will cause a lot bigger drop in your credit score, which, life events happen. I think the rebound from those doesn't take as long as it used to. Typically, for it to fall off your credit report, it's 7 years. But what I've seen with how we look at reports, it's really in the last 2 years. If it's more than 2 years out and there's no additional lates and it's like an isolated event, it may not have that big of an impact. But where I think this is going to have a huge impact for people is people with collections, because those normally are going to have current lates associated to them, which basically just drops and plummets your credit score, which is not a positive thing. This is why we encourage budget. Budget leads to good credit. So you really need to hunker down, because one small thing could derail your whole operation. Now, there's greater reward for responsible borrowers. So if you keep low balances and make payments on time, you'll see the biggest boost in your credit. Now, who is this going to affect the most? Now, FICO estimates that 110 million people will see a credit change due to this update. That's huge. About 40 million consumers will see a 20% increase. Those are people that are keeping low balances and have a strong payment history. Now, about 40 million consumers will see a 20-point drop. People with high utilization, past due payments, and delinquencies. Now, the remainder is going to see minor fluctuations to their credit report. Now, who is going to be the most at risk, which is anyone with high credit utilizations, consumers with recent lates. So it's not like you're grandfathered in prior to this, right? Like, oh, I had a late last year, but now we're going to a new model. Now it's going to affect anything moving forward. Nope, it's going to recalibrate based on what your past you've been doing, like what your past looks like. That's why this is such a dangerous piece. Now, obviously, this benefits people that pay their balances in full every month and don't carry a credit card. And this is kind of associated with charge cards, right? A lot of people will utilize credit cards for points, like I do that, and I pay them off every week. Or with like some credit cards, you can actually have a negative balance, and then you can actually charge up things from there. Now, a quote from the FICO VP that was talking about this is that they've said those consumers with recent delinquency or high utilization are likely going to see a downward shift in their credit scores. Now, why is this change happening, and what is going on here? So why do lenders want this change? So lenders have seen an increase in delinquencies, and they want a better model that predicts risk. Now, I sit on a lot of these meetings with like Fannie, Freddie, and the credit bureaus, and that is true. We've seen a higher delinquency rate across the board, from mortgages, credit cards, car payments, all of that. Now, old models don't penalize long-term balance carries, which can become very dangerous. Some people will do credit card hopping, where they'll do 0% interest, then flip it to another card and do 0% interest. So if you have a really good credit score and you do that, maybe there might be some merit in there for you to be able to continue to do that. But again, with these new changes, things may change. That's why you got to really be ahead of the game on this, so you don't put your credit in such a risk that you basically disqualify yourself from being able to potentially get a zero interest credit card so you could transfer that balance. That's why I think the consumer mindset really needs to shift. And I feel that a lot of people, this is my opinion, are going to get completely sidewinded by this here in the next couple of months. And it's going to cause just a lot of people to have undue hardship. Well, I mean, they're changing it. If you're not tracking it, there's going to be some change, and you may put yourself in a worse position if you don't get ahead of this. Now, one credit expert says that this isn't consumer unfriendly. People with good credit will score higher, and those with elevated risk will score lower. Basically, what that means is this change isn't meant to punish consumers, but to reward financially responsible behavior while identifying riskier borrowers more accurately. And this is what lenders are looking for. Now, the things that you guys can do to protect yourself in this manner is to really shift your priorities when it comes to how you're paying down debt. Even if you may have 0% interest credit cards, should you be more aggressive on paying those off? And that really is going to come down to your budget and what you can do. Because again, missing a single payment drops your score between 50 and 100 points. So it takes a lifetime to build credit, but one instant could drop it. But again, they're going to look at your pattern, your history, and if you just have a onesie here or there, normally we don't see as much of a big impact. So one thing with credit utilization, because it's a big factor in the scoring model, is you really want to be at 30% or lower. Now, what they say with this new model is they want you to keep it at 10% or lower if possible. And that is a huge difference for people, especially if you have, let's say, limited credit. Because let's just be honest, if you have a credit card with a $500 balance and you go get gas and groceries, you're already at like $200, $250 for the week, right? Depending where you shop and also what kind of car you have, you may be paying a lot more than that, unless you have, electric car or something like that. But I'm just giving you a quick example. Now, for that person right there, if they rack up 50% utilization rate, their credit score could take a big tank. And then, so you kind of in this vicious circle. So make sure you guys are tracking that. And another big thing is not opening too many accounts at the same time. That will be also a red flag. And if you're thinking about doing a balance transfer, let's say if you're paying a lot of interest on a credit card, but you have a good credit score right now, does it make sense to look for credit cards that may have 0% interest that you could do a balance transfer to? That's up to you guys to take a look at. If it was, me and my shoes in that position, I would look at like, hey, how can I minimize my monthly expense from an interest perspective? Because then I can make bigger payments towards paying down the principal instead of paying interest. So that's just something to think about, because especially if you have high balances, that could 100% eat away mostly you just paying interest, and you're just never going to pay it down. Then it takes forever. A million calculators out there, and I believe even your the credit card company sends you, like, if you make the minimum payment, this will take you, X amount of years and how much interest you're going to pay. So those are all things you want to think about. So please make sure you guys share this video, because there's a lot of changes coming in the industry. Plus on the channel, we do a ton of stuff around understanding, utilizing your V home loan benefits, how to prepare for it. Hey, I'm a homeowner. what can I do? All that, just go in the search feature on the channel, and you guys will be able to see any type of videos you guys want. And if we don't have them, no big deal. We'll create them. Just drop a comment down below. So hope you guys got some good value. Hit the like and subscribe button, and I'll catch you guys soon.